Good day, guys. Welcome to Forex Walker. Welcome to episode 67. Now, this episode answers the question that says, how do I trade? What are my methods? Now, my method here, I was trying to create a table. I was supposed to use a table method, but I just decided to just draft these things at random, and I was supposed to be numbering them, but I did not number them. So this will be one, two, three, four. Now these are the four things that I'm gonna be using. But this is not everything. I'll try to show you the other things that I add into my trading method, but there are many other things. So for now, I will be explaining a little bit of my trading method because a lot of people ask me about I forgot what they call it, but it's something like a price action trading method, something like that. But I don't use a price action at all. I just uh, bake in what I have on the macroeconomic side with price action. So I cannot look at price action without the background of the economic reports. So that's how I trade. So this is the trading method. The first one is economic divergence. Now, in economic divergence, what I do is that I look for one currency that is performing well, and I combine that currency with a currency that is performing badly. I know that when you look at YouTube, you cannot read what is written in this form, but I'll be reading it for you. So you look for in economic divergence. This is the key trading method. So you look for a currency that's performing well on the macroeconomic side. This is macroeconomics. This is an economic calendar called trading economics. So the method would be observed from trading economics, and that method would comprise of one currency performing well and the other currency performing badly, and we combine the two currencies to find what we call economic divergence. One currency doing well, one currency doing badly, and that divergence is the trade that you're going to be taking, either long or short, looking at who's stronger and who's weaker. Now, the second trading method, which is the most powerful, this one here, you can actually trade it for more than 3 years. It's called monetary policy divergence. Now, this one is the largest method. In fact, economic divergence, I can classify it as a 3 month to 6 month trade, but monetary policy divergence trades can actually last for 3 years. So the trading style, it's called position trading, and in monetary policy divergence, you were looking for one central bank having hawkish stance, and you want the other central bank to have dovish stance, and that involves one central bank beginning to hike rates and the other central bank not even mentioning interest rates. In fact, you find out that the currency is actually moving deeper into a recession, and the other currency is already talking about hiking rates or hiking rates. So that is the economic divergence. You're gonna buy the currency that is hiking rates or beginning to hike rates, and you're gonna sell the currency that is getting deeper into a recession, and you can see that the inflationary numbers are actually collapsing into the zeros, or the inflationary numbers are actually at the highest point, and the GDP is actually collapsing into the zeros. So you want both the GDP and the inflationary numbers to move towards the benchmark that would be the target for the central bank. But if the opposite is happening, you can actually sell that currency and buy the currency that is actually moving into uh, 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 a hiking session. And you can also when you are in a out when you are in a booming market, you can actually look for a currency that is holding rates, and uh, buy the currency that is holding rates and sell a currency that is actually cutting rates or moving into an interest rate cutting cycle. So holding rates is hawkish, and also hiking rates is hawkish, and uh, cutting rate cutting rates is bearish, and holding rates can also be bearish, depending on whether you're moving into a recession or into a booming market. Now, geopolitics involves wars and elections, and anything that is said by a politician, like Donald Trump, he can say something and all market collapses or it rises, all of those things. So that is geopolitics. It involves wars, elections, and what politicians are saying, or if the politicians are not having an agreement, and you can see that they're moving toward having a war, you can take a trade in that direction of what you are expecting, but you need to understand geopolitics for you to be able to take advantage of the trade. Now, market sentiment involves what high-ranking officials are saying. I apologize for that. Now, what high-ranking officials are saying involves uh, it could be what the central bank governor is saying, what the hedge fund managers are saying, and it can also involve geopolitics, what the politicians are saying. So market sentiment just involves what high ranking officials are saying. Now, what high ranking officials are saying can also be involved, can also include trading status. Trading stat is a COT report. So it tells you what the commitment of traders are. So COT means commitment of traders. If you want to see the COT report, this is the COT report for the main currencies. And let's look into the Australian dollar and what the hedge funds are actually saying. Now, remember, this includes this is included in market sentiment. It's just market sentiment. So it says Australian dollar, Chicago Mercantile Exchange, and that is the COT report. Let's hear what they're saying. Now, here you have the dealer, and here you have what I look at, which is a asset manager or institutional. So what it means is that this is the central bank managers inside of the Chicago Mercantile Exchange. You need to know what they're doing, and this is leverage. It shows you what the leverage is. What uh, as you can see here, they are leveraging south. They are leveraging in the shorts, and you can see that here they're opening shorts and they're closing longs. So this is the COT report. It also involves market sentiment. So if you want to know what the hedge funds are doing and what the important people are saying, you can actually also look into the Reuters. This is Reuters. U.S. Israel talks without a deal. Uh, Delegations. So you need to look into the geopolitics side for you to be able to understand uh, what will happen in the future to the oil market and the commodities currencies. Now, this is Iran aims to restore most refining capability within 2 months and all of those things. And you can look into Reuters, and Reuters will tell you this is elections. This one is geopolitics actually. Hungarians vote in elections that could oust Orban. That means they're expecting this man over here, Orban, the prime minister of Hungary, to win the elections. So, and the United States said something like, if Orban wins the elections, the United States will invest in the Hungarian economy. That was Donald Trump speaking. Now, this is geopolitics. It can also be classified as uh, market sentiment. So, this is just a combination of market sentiment and geopolitics. This is war cost shadow over IMF World Bank meetings. So that's wars is the main key factor in what they are saying inside of the IMF, and that is what they're going to be doing. So that is geopolitics, a combination of geopolitics with market sentiment, and those are the systems that I'm using. But the main key system that I'm using is called trading economics, where I look at the performance of different currencies, what they do, and I look into that and I decide whatever I want to decide, whether I'll be going long or short. And up here, I hope you can see that this is Trading Star, this is XM, one of my brokers, this is Reuters, and this is AvaTrade. I don't advertise any broker, but those are the two brokers that I'm using. And I'm also using Blueberry Markets, which is not shown currently. So this is in a nutshell the systems that I'm using for trading. This is one of the trades that I took, and normally what I do when you see this line that you see here, this purple line. Normally, what this line is, I draw it before the market takes any form. So I call it a market a price action projection, where I project market fundamentals into price action. So I call it a price action projection. This is the previous shoulder that we are going to be looking into. Let me just move it. I don't know whether it was up here or what, but this is the previous shoulder. So what happens is that this bottom of this line, the bottom of this line is down here, the lowest point, and the highest is the 50% fee. Remember, with currencies, we trade the 50% fee, the zero point 0.5 means 50% fee of the Fibonacci. This the Fibonacci. Let me try to show you what the Fibonacci is. This is the Fibonacci retracement levels, and this is the 23.6 and 50% fee. So those are the two levels that I trade with currencies, and with commodities I trade the 38.2 and the 23.6. So what happens here is that the lowest point is down here on this line, and the highest level that we expect is the 50% FEEP over here. And we expect a reversal to the previous shoulder, which is this one. This is the previous shoulder, and the market did actually retrace to the previous shoulder, and then it went bullish. That would be the trade that we would be holding long, and that would be the take profit level on this line. So this is, in a nutshell, the price action side of it. And when I do, when the market is moving sideways, I look into this method is called Wyckoff schematics, the turnaround part of it. And when the market moves long term, when it moves out of a correction, this is a correction. When it moves out of the correction, we call it Elliott wave. So I trade uh, uh, Elliott wave when the market is trending, and Wyckoff schematics when the market turns around. So I will thank you guys, and I'll see you on the next episode. Goodbye.